Good morning all and welcome to today's video. So today I just have one pair on watch, which is pound Kiwi. The market looks like it's made other plans across the board and the price action is looking a little bit ugly, a little bit undeveloped at the moment. So one of the advantages of the way that we trade, those of us who trade the Falcon strategy, is that even if price does something different to what we were anticipating, the entries that we look for can help us to stay out of trades and help us to determine when the market is doing something different. So it's not always about being right. It's never about being right in trading. It's about having a set entry criteria which allows you to determine when the market has made other plans and when you should stay out and when you should be looking for entries. And across the board, as I say, the market looks a little bit undeveloped now because we've had some the price action just looks like it's developing other things. So one of the biggest things in trading is staying out of the market. And I was thinking about this morning when I woke up. I was thinking about how, like, for example, in most professions, if you're an accountant, your job is to account. It's to cook the books, as it were. Okay, and you feel like if you're not doing that, then you probably feel like you're not actually an accountant if you are a qualified accountant. But there's some professions, like, for example, being a fireman, a firefighter, I guess they're called these days. If you're a firefighter, for example, most of the time you're just sat on your hands waiting, to be called into action, as it were. And, there's other jobs like that as well. But yeah, trading's much like that in the sense that we have to sit on our hands the majority of the time. Trading is predominantly about not trading, unless, of course, you're a scalper or something like that. But for the majority of us, trading is about not trading, and you will find the statistics now prove that the people who trade the least are the most profitable ones. Okay, not everybody who doesn't trade very often is profitable, but over a large sample size, people who place less trades are typically more profitable than those that place lots of trades. So anyway, with that in mind, let's break this pair down for you now. This will probably be a shorter video simply because we have just the one pair on watch today, but let's break this down for you now. So pound Kiwi on the higher time frames. If you're new to my videos, I'm looking at this one because we have on the daily chart, we have this sharp move up, sharp move down. I'm just ignoring these wicks as volatility spikes because you can see that if we just flick to the line chart, a good way to determine whether something is volatility or not is to just flick to the line chart. And if those wicks don't appear, then that likely means that they're not indicative of the sentiment of the market. And it's the sentiment of the market that we're trying to ascertain, which helps us to determine, what the structure is. The structure is the sentiment of the market. And if these wicks don't appear on the line chart, then they're probably just volatility. You can see that on the 4-hour chart they do appear, but you can't see all of the price action on the 4-hour chart. So any of the bigger players that were looking at this on the daily chart would not be able to see those wicks if they flick to the line chart, and that is one of the things that it would appear that they do, because a lot of the time these wicks are simply price action simply, when it develops, simply ignores the wicks. Okay, when it reacts and responds to structure. So we have the sharp move up and sharp move down. The sharpness of a move typically indicates how much liquidity was placed there in a short period of time. Okay, so obviously if price took longer to get to this area, then there's potentially not as much liquidity there being placed there in one go, at least, as if we just went sharp move up, sharp move down. Okay, so sharp move up, sharp move down, that gives me a clue there's a lot of liquidity there. And if we were looking at this as we would have been, excuse me, if we were looking at this as a potential impulse, let's use the right tool, shall we? If we were looking at this as a potential impulse correction continuation to push lower, when the correction gets this wide, so when we get a correction which is this wide relative to the move down which preceded it, that is a very, very strong indication that we're not committing to the downside. We're not going to see this impulse correction continuation, and that instead we're going to scoop up and give ourselves what we call an M-style pattern. So when we get something like this, when so much volume appears to the downside, underneath a liquidity point. When so much volume occurs, often price will break up, break below, break up and then break back in, which is what we call an M style pattern, or a W style pattern, if you wish. So this is the point is that this is non-progressive move in terms of a move to the downside, because it's just traveled sideways. So then we break above here. We break above. I talked about on the higher time frames how people typically believe what was previously resistance becomes support, particularly on the higher time frames. And that's because the media, and when I say the media, I don't just mean the news, I mean broker platforms, etc. They get hold of the fact that, for example, pound Kiwi is at a 3-year high, and when it breaks above, think about what's going on in the minds of people that want to get rich quick and think that are treating they're trading like a casino. They're treating the market like a casino. If they hear that something has broken a 3-year high or an all-time high, for example, what are they thinking? They think it's just going to keep going. If you had no knowledge of trading, what are you thinking? I've spoken to people in my family about the price of oil, for example, and when oil was at a certain price, I predicted it going down to, I can't remember what it was, but whatever it got to, which it did. And then when it was at that price, I predicted that it would get to about $126 a barrel, and all of my immediate family were thought I was mad and said that's ridiculous. But we could see the the structure highs and the structure lows, and of course it did. I think get to about 130 or 100 something in that region. So it did happen. So, people think, for example, when it breaks above here, and when I'm talking to people, maybe in my family saying that, oh, I'm looking at price to go down to whatever value, they think I'm mad because they're just seeing it go up and up and up. If people are worried about the cost of living, and they're seeing natural gas and West Texas oil, etc., go up and up and up, and I'm saying, oh, it's going to be down at this price or likely to be down at this price by whatever time, they think I'm mad because it's emotionally driven. They're fearful. They see something keep going up and up and up, and they just think it's going to keep going. Well, that's not typically how the market works. Okay, so when we see this, it's often the case that it breaks above because people think it's just going to keep going. But what we see in the majority of cases is that it comes crashing back down again. Okay, and this is what we call mass psychology, people getting caught the wrong side of the market. Of course, you could have made some money in this move here, but at the same time, you've got to ask yourself, if you're constantly buying the highs, you can see that this is a high, you can see it's at like a 7-year high. How much money are you actually going to make if you're constantly buying the highs and selling the lows? It may work out momentarily or occasionally, but most of the time you're capping your profits, as it were, even if you do actually make money. So we see people caught the wrong side of the market. It comes crashing down. We have that impulse correction continuation, which is the natural ebb and flow of the market. We don't normally see corrections this wide early up into the run if we're going to head to the downside, but sometimes it can happen. One of the reasons it can sometimes happen is because obviously when we're up here and we're kind of in no man's land at this point to some degree, it sometimes takes a little while for the confidence of the market to kick in. Although the bigger players know that people are getting themselves caught the wrong side of the market, sometimes it can take a while for the confidence to kick in before the big moves to the downside occur. And then once we are trading back beneath the high where people got caught the wrong side of the market, that is typically where the aggression starts to come in. You can see that here. Okay, so just trying to give you a bit more of an in-depth analysis into the mechanics of the market, seeing as I have less pairs on watch today, and seeing as I can break down more of my thought process. So when I'm making these videos, I'm not normally taking you through my entire thought process. Through my entire thought process, that's a bit of a tongue twister, simply because there's so much that goes on in my analysis that I can't actually fit it all into a 20-minute video. But when I've got less pairs on watch, obviously I can. So what do we have here? We had this kind of M style pattern that I talked about, and then we came crashing down, right? Now, price is often repeating itself. Now, we may be seeing the same thing again here, okay? So we have all this volume build up below here, and if you remember rightly, as I said, it's not about being right. I'm not interested in being right. There was a trade that I took in here, and that was a loss earlier in the week, and I documented that in one of my videos. But then price formed something else. Okay, so we had all this volume, we had a very clear 1, 2, 3 touch structure, and then price just didn't commit. Okay, and it pushed up, and then it looked like last night like it was forming the very clear psychological pattern. Okay, so we have this 1, 2, 3, and if I just drill down, I'm just going to take you through this. So I was looking at this once we broke out of here, and last night I saw. So where did I place a trade? I placed a trade. I think it was in here somewhere, or that was last week. I can't remember where it was, but anyway, it's been documented. Feel free to watch my previous videos. But we had a very clear piece of structure here. Okay, so we broke out of this piece of structure, which I just had my ray line placed on, and then if we just measure this, so when we see structures like this, typically the leg out of the correction, the middle section, so we have this impulse correction continuation. The continuation leg tends to be of a similar length to the preceding impulse. So we have an impulse correction continuation, giving me a clue that when we were up here, we would like that move had likely finished. We also had, if we just touch on it, we also had this middle section here where we have this impulse correction continuation. So these are all psychological patterns. Okay, and that gave me a clue that that's completed, and you can see it did because it pushed up. Okay, you can see that we're pushing up a bit higher, but then that doesn't surprise me. Last night I was looking for moves. I thought it might break a bit higher, and one of the reasons I thought it might break a bit higher is because if we just look at when we get these, this is a good indication. When we get these bullish candles with a big wick beneath them, that's often an indication that we're likely, if we are going to push lower, we'll likely push a bit higher first. Okay, so when I saw this daily close, that gave me an indication that we may push a bit higher before potentially breaking back in. As did, we have the same thing here. We have this bullish candle here with a big wick below it. That, and the same thing here to some extent, a bit of a wick below it. That gave me a clue that we would likely break a bit higher. But regardless, we have this very clear psychological pattern that we look for here. And what we typically see, or what we sometimes see, is we see a correction just below the area of value. Okay, so if we have this 1, 2, 3, which lines up with this area of value here, and the reason I've got this as an area of value is because if you look at it, you can see that 1, 2, 3, the 3 drives, first drive, second drive, third drive, a completed mini piece of structure, which was the causation of this sell-off here. Okay, so on the higher time frames, there's another thing to factor in. On the higher time frames, we typically break above things before breaking back in and catch people the wrong side of the market. We don't typically do that so much on the lower time frames, so I am mindful of that because you can see we've broken some distance above this. Okay, which is not overly common. Okay, it's not overly common on the lower time frames so much because less people are paying attention to what is to many people just an inflection point like that, if they're even paying attention to it at all. However, we do have what we call an ending structure. So when we have a corrective move up such as this, and then we get structure at the end of it, and what I talk about often, the FOMO leg, so where we get close to the area of value and then we sell off, but then price comes back up, that is often indicates that this is an area of value if the third touch happens to line up with it. So this is just things I'm factoring in. Okay, so one of the things we typically see at an area of value as well is we see a little tight consolidation like that. So that ties in with the fact that this may be an area of value. And I say maybe, but as I said, I'm mindful of the fact that we've broken past this to some degree. However, another thing I factor in is the fact that when we get this much volume, so when we get this much volume, if this is an area of value, when we get this much volume build up beneath it, that's another reason why sometimes price can break a bit higher before breaking back in, because all the people that were trading within here, as they bail out of their positions, the amount of people trading within here can cause price to break a little bit higher before it breaks back in. So this is just my thought process. So with all of that in mind, and they've just moved the objects tree, so TradingView have just moved that. So what I'll be looking for today is if price breaks back in, and I do want to see a break back in, if we impulsively break back in, if we did get a correction afterwards, we would likely get one next to this little consolidation to the left, because that's what often happens, okay, when we have a little consolidation to the left. And then we would have this kind of mini head and shoulders pattern. And I'm just going to reset an alert here. So I'm going to set an alert here now. on the fly. Previously, I had an alert set lower, just in case we push low. I did my forecast last night, just in case we push lower. And if we got a correction like that, then I have structure to work with. Okay, so I'd be able to manage my. What's happening there? I would be able to manage this trade down to here if I got an entry on the break of a flag such as that for something in the region of 3%, which would mean I'd likely be able to lock in 1% or more. And then the real first target is there, and we could manage that. I would start managing slightly more aggressively there, and we could place a trade there for something in the region of 5.5%. Of course, if we got the risk entry within the flag, which I would consider, then obviously the risk to reward, as it often does, nearly doubles. So that is what I'm going to be looking for today, folks. As I said, I've tried to go in a bit more in depth than I normally would. And of course, if price just keeps breaking higher, of course, we do have that kind of sharp move there. So it wouldn't surprise me if we go all the way up there. But, I think by this point, if that was to shape up by the end of the day, then I feel like you're kind of tracing this trade a little bit, because there's kind of not really any structure to work with. Of course, if we formed something like this, so what would the proportions of that be? So one of the things I'm doing is I'm looking at the proportions. If we just take the fib tool and we measure that from there to there, so if price pushed higher, that would be like a 45% retracement, which would be okay. But what I'd be looking for, if we pushed up to this area, we may get something in the region which would make this a bit more reliable. If we got something which was a bit more, let's say, like that, and we pushed up like that, and then we had kind of this structure to work with, okay, that would be something I would consider. But for price to push up to this area by the end of the day, I would expect some kind of price to mess around for a little while. So that's what I'm going to be looking for, folks. And let's just get everything back on the charts. There we go. So yeah, as I said, trading is largely about not trading half of the time. And when the market is doing stuff like this, I don't mind, because I just get on with other things. There's things that I need to catch up with that I haven't been able to catch up with because the market is so active. Okay, my partner is very, very ill at the moment. I haven't discussed this before, but my partner actually has stage 4 colon cancer, which is spread to her liver. Okay, so I think you can probably all give me a little bit of credit for showing up and being as positive as I am in these videos with all the things that I've got going on in my personal life at the moment. It's not always easy, but I try and show up to make these videos for people. And one of the things that all these commitments that I have does is force me to switch on mentally, one of the things when you're going through difficult times is to keep doing what you were doing before. Okay, I think it's a slippery slope in life. I've seen this happen, like with an uncle I had many years ago, where this guy was really smart, good looking guy, always used to take care of himself, and then he split up with this girl. And I talk about this because of how psychological trading is as well. He split up with this girl, and then over a period of a few years, it was a slippery slope where he's just appearance diminished, and he just didn't take care of himself, and eventually he died. He was like 33. So one of the things that's important for me with all that's going on in my personal life is to show up regardless of what happens, to do exactly what I always do in exactly the manner that I always do it, regardless of what's going on. And that is the thing, that kind of mindset, that bulletproof mindset, is going to be the thing that in trading is going to make you or keep you a consistently profitable trader, and make you basically bulletproof to any situation that occurs in trading and in your personal life. And I think that's something that we can all take a lot of inspiration for, I'm sure. So anyway, that is my forecast today, folks. I hope you've taken some value from this. And tomorrow is Friday, and if I have a pair or pairs on watch, or if this entry shapes up that I'm looking for, then I will, of course, update you regardless of what happens with that trade. If it does shape up, win, break even, or loss. So thanks for watching, folks. I will be back, as I said, tomorrow most likely with another video. But in the meantime, have a great day. Stay switched on, and I bid you a great day, and I'll speak to you again soon. Thanks for watching.